If you find this video helpful, please don't forget to like, share, and subscribe. Ever wake up to find your stock's price slashed, but your share count doubled? No, it's not a glitch. It's a stock split. Companies like Apple and Tesla do this all the time. Your total investment value doesn't change, you just own more smaller pieces of the same pie. Think of it like slicing a pizza into more pieces, same pizza, just more slices. Stock splits are strategic, not random. They're announced in advance and don't make you richer overnight. So what's the point? And how should you react as an investor? Let's break down the mechanics and motivations behind stock splits so you can make smarter decisions. What is a stock split really? Why do big companies do it, and what does it mean for your money? Today we'll strip away the jargon and explain the basics, the math, and the strategy behind stock splits. We'll look at real-world examples: Apple, Tesla, Google, and even touch on reverse splits. By the end, you'll know exactly what a split means for your portfolio and how to think about it. Ready? Let's dive in. A stock split increases the number of shares by dividing each one into smaller pieces, without changing the company's total value. Picture a pizza. Before the split, it's cut into 4 big slices. After a 2-for-1 split, you have 8 smaller slices but still the same pizza. You own more shares, but your ownership percentage stays the same. The board decides the split ratio, 2-for-1, 3-for-1, or even 20-for-1. The share price drops proportionally, so your total investment value is unchanged. It's a division of shares, not a multiplication of wealth. More shares, lower price, same stake in the company. Let's do the math. Say you own 10 shares at $600 each, your investment is $6,000. The company announces a 3-for-1 split. Now you have 30 shares, but each share is worth $200. 30 times $200? Still $6,000. No matter the split ratio, your total value doesn't change, just the number of shares and the price per share. It's an accounting move, not a value boost. The split is always value neutral. Remember, more shares, lower price, same total investment. Imagine a company worth $1 trillion with 1 billion shares. Each share is $1,000. After a 10-for-1 split, there are 10 billion shares at $100 each. The company's value? Still $1 trillion. In your account, 5 shares at $1,000 become 50 shares at $100. Your total? Still $5,000. The split just makes shares more affordable and flexible for investors. It's like trading a $100 bill for $5.20s. Same money, more pieces. Companies do this to make shares accessible, not to change value. The key: more shares, lower price, same value. One of the most significant and frequently cited reasons for a company to split its stock is to make its shares more affordable and accessible to a broader range of investors, particularly individual retail investors. Imagine a highly successful company whose stock price has soared over the years, climbing from double digits into the hundreds, and eventually into the thousands of dollars per share. While this incredible growth is a testament to the company's success, a 4-figure price tag can create a powerful psychological barrier. For an investor just starting out with a modest amount of capital, the prospect of needing over $2,000 to buy a single share of a company like Alphabet before its 2022 split can feel incredibly daunting and prohibitive. This barrier isn't just about the practical ability to purchase a share, it's deeply rooted in human psychology. A lower share price simply feels more attainable. When a stock splits and its price drops from, say, $900 to $300, as was the case with Tesla's 3-for-1 split, nothing fundamentally changes about the company's valuation. However, the perception of its accessibility is completely transformed. An investor who might have hesitated to commit $900 to a single share might feel much more comfortable buying 1, 2, or even 3 shares at the new, lower price point. This opens the door for a new wave of investors who were previously sitting on the sidelines, feeling priced out of the market for that particular stock. Furthermore, the advent of fractional shares, which allows investors to buy a piece of a share, has only partially solved this problem. While it is technically possible to buy $100 worth of a $2,000 stock, many investors still prefer the mental comfort and clarity of owning whole shares. There is a sense of completeness and true ownership that comes with holding 1 or more full units of a company's stock. By lowering the price per share, a company caters to this psychological preference. It allows smaller investors to build a position in whole share increments, which can feel more empowering and less like they are only able to afford a tiny sliver of the real thing. Ultimately, this strategy is about democratizing ownership. A company's management often believes that having a diverse and broad base of shareholders, including employees and loyal customers, is a healthy attribute for long-term stability and brand loyalty. When employees can more easily afford to buy shares in the company they work for, it can boost morale and align their interests with those of the company. Similarly, when customers can easily become owners, it can strengthen their connection to the brand.